We have no idea what's going to happen this year.
I think there's still a bit to get through. You know, there's still
heaps to get through.
There's still a lot to get through in 2021, but you know, the overall outlook from us is once again optimistic.
Hey there, guys. Welcome to 2021. We made it.
We made it. I think there's a lot of people out there happy for there to be a 1 at the end of the year now.
Without a doubt. Like, 2020 was an insane year. Big year. So much happened for so many people around the world. But 2020 is shaping up to be super, super excited. And that's why we want you to have the information that honestly, you're not going to hear in the media for at least another 6 months, if until 2022. This is the stuff that we find, that we pay for, that clients send us, which is the nitty-gritty stuff that you need to know as an investor about the coming year, so that when other people are still freaking out, you can take calculated and strategic action for your own portfolio.
Hell yeah, it's really exciting to go through all of this information that we've been receiving and just see the positive outlook from all of these big analysts and big forecasters in the Australian economy. It's really cool.
I've been following data for 10 years. The data that I followed for the first 4 years was really bad. I was following all the wrong people and all the wrong advice. But, now I go to the right sources, the CBAs, the Westpacs, the Phil Andersons, the Fred Harrisons, the CoreLogics, the HCWs, and the big boys like the SQMs that really have huge amounts of teams just crunching this stuff, and they have so much to lose by putting their name on bad information.
What I love about these guys as well is it seems to be a lot less biased information as well. You know, they're just throwing out their opinion as to where they see things coming. And as you said, there's such massive teams that they're working together to organise those types of things. But yeah, I just love that they're not coming from a place where they're trying to convince anyone anything. They're just, going out on a limb and having a crack.
I remember a few years back, I was reading Ray Dalio's book, Big Debt Crisis.
Yeah.
Absolute cracker for anyone like me interested in history and learning from it to make better decisions in the future.
Yep.
And he said that, basically he just said, don't try and compete with me or my company, because he's literally investing $100 million a year on research and data. And so rather than try and figure it out myself, I just read everything that guy puts out and his team puts out, because it's sort of like a crystal ball into what's coming down the line. Now, why I mention that is back in, I think it was September last year, both him and Warren Buffett came out in Bloomberg.
That was in 2019, not 20.
Oh, sorry, 2019. Far out, that's gone quick.
I know, right?
No, they both publicly came out and said the risk versus the reward in the current market is no longer worth it. We are 100% in cash. Now, I'm just going to look at that as sort of almost the canary in the coal mine in the future, knowing that these guys wouldn't have shared that information 10, 15 years ago when they were competing to be the best. But now they're at that stage of life where they genuinely want to help and protect people.
Just give back.
Epic information to be aware of.
Yeah, no doubt about it. So there's a lot to get through today, guys. We're going to talk from a lot of different people's perspectives and, talk a little bit about what could happen throughout 2021. Obviously, nobody can predict the future and nobody knows what's going to happen, but these are the big dogs that are coming out and going out on a limb, expecting a number of different cool things to happen. So why don't we start with some things that we got from CommBank?
Yeah, so CBA produces an incredible update called Economic Issues, as in like issue 1, 2, 3, not issues. And one of the first things that is important to note about 2021 is that there is unprecedented amounts of infrastructure coming into Australia. Now, if you look at Phil's stuff or Ray Dalio's stuff, one of the levers that they can pull to get us out of a poor economic environment globally is infrastructure. You look at China's One Belt, One Road project. You look at the Middle Eastern's Neon, their new city that they're talking about creating. You look at what's happening in Thailand. You look at what Trump's been doing in the US in terms of rebuilding America for the first time in 50 years. Australia is absolutely no different. Now, what sort of dollars are we talking, bro?
It's expected throughout 2020-2021 financial year, the government's going to spend over $116 billion on infrastructure spending, which is an increase of $31 billion year on year, which is insane. So this is exactly what Phil's been coming out and saying as well, and Catherine Cashmore saying that infrastructure spending is really going to kick off the second half of the cycle.
Yeah, so infrastructure always leads us out of the mid-cycle slowdown. It's no different in Australia, and that infrastructure is spending is spread really consistently throughout the Australian economy, throughout states, throughout major regions. Obviously, some winning, some not getting as much, but what that is really intended to do is re-stimulate the economy, businesses, and create jobs. And then those people therefore get back into the economy, start spending money, start buying houses, start buying stocks, and that brings back sentiment down the line.
The interesting thing with infrastructure as well is what, Phil talks about, Akhil talks about, which we'll get into, is the impact of that infrastructure as well and what it does to the surrounding suburbs, especially if it's sort of public transport options and things like this.
Yeah, we'll talk a lot more about this towards the end of the podcast, but basically the more money that flows in from an infrastructure perspective in terms of key transport corridors, trains, main roads, directly results in a lift in property prices in those key areas. Now, we're not talking about going from 2 lanes to 3 lanes. We're talking about major projects, 3 to 6 lane highways, brand new railway stations and metros, stuff like that.
Yeah, you actually sent through a breakdown of the infrastructure spending, and we looked into a lot of the different things that are occurring in southeast Queensland, Brisbane, Sunshine Coast, Gold Coast, and it's going to be really exciting to see a whole heap of these upgrades, because as that population increases, the roads are getting busier, the trains are getting busier, and it's just going to be nice to see a little bit more connectivity, and it's just going to be faster time frames to the city and things like that, hopefully.
For sure. And what I love is, more importantly, they're thinking about it before we get to the size of Sydney and Melbourne. You know what I mean? They've sort of learned some lessons.
I love Brisbane for that fact. I swear they're so much more proactive than reactive compared to Sydney and Melbourne, hey?
For sure. Now, another thing that CBA came out and said is that consumer confidence is at a 7-year high. Now, that's really important because anyone that understands investing understands that most of the time it's completely illogical. It's got 100% to do with how people are feeling on the day, that year, and the market. Now, with consumer confidence being as high as it's been for 7 years, that's a really positive thing moving into 2021, 2022.
Now, I was literally watching the news this morning, and they were coming out saying that they're expecting to have about $11 billion left over in the JobKeeper scheme once it comes to a close in March, because what they were saying is the bounce back in a lot of these industries, and people are getting back to work, so businesses no longer need to have their staff on JobKeeper payments. There's going to be a whole heap of leftover cash, which is really exciting as well.
The reason it's important to have some of that leftover cash is because some people believe that from March, and it may or may not happen, we don't know, like they thought in September 2020, that once that I can't say that word, fiscal stimulus runs out, some of these industries and some of these small businesses will be very vulnerable. And unfortunately for some of them, that will be the case. But with having $11 billion left over, and they might add another $10 billion to that, they might be able to really support the last of the tourism operators, the retail operators,
education,
the educators, and the small businesses that are struggling. Now, I was talking to my dad in Sydney back at the end of 2020 when I flew down, and he was sort of saying that, he's got 14 or 18 staff on, and he was saying that, that money running out in March or him not requalifying again will be a big deal to his business because it's been absolutely smashed as a result of this. But fingers crossed things start to, work out a little bit better, or he can requalify and continue on.
Yeah, exactly. And the next thing which was really, really nice to read, is CBA has blatantly come out and said that the Australian housing market is no longer a source of risk.
What they're referring to there is they've said on home prices, it is clear that price falls will only end up being modest nationally. In fact, in most capital cities, house prices are now increasing. Now, that is a huge thing, but if we go back to the videos and the content we're putting out in February through to June 2020, we talked about the mid-cycle slowdown, and if you look at the long-term research from Fred Harrison or Phil Anderson, Ray Dalio, in these mid-cycle spots, the worst performances in the last couple of 100 years in America and Europe in terms of drops in houses during this time of the cycle is a 10% decline. Stock markets have got hammered by an average of 38% during that time, but it's important to note that you've been aware of this if you've been following our stuff for a while, that it was never going to get much worse than that. The reason being governments are so ready to step in and throw money on the fire, and reserve banks and Fed banks and, whoever else, like international monetary funds, are so prepared to just jump in and sort the issue out because they can now. And we'll talk about the bigger picture cycle in a minute.
Super exciting. It's much better than the initial forecast from some of the doomsdayers that were saying a 30% drop in Australian house prices at the beginning of the coronavirus. So it's nice to see that we've got 9+ months worth of data to look back on and review on now, and it's quite clear when you look at that the property market hasn't been smashed at all.
I think Melbourne's the only market at the end of 2020 that's still showing declines in prices. They've also got a pretty significant, in 2021, oversupply of inner city units, as does Sydney. We're seeing vacancy rates in those areas still ridiculously high. To me, that is a source of risk. But what I think is going to happen over the course of 2021 to 2023 is we'll, as soon as we can, start allowing the international students, the international tourists, as well as the international investors and self-managed super fund buyers back into the markets. They'll call it to support the Sydney and Melbourne markets, and it's going to result in more and more pressure placed on those markets. Without those things happening, I still, like I've been saying for years, believe that Sydney and Melbourne, if it's just an Australian market, are overvalued. But what the hell do I know? What I mean?
But I can see it happening. I can see the borders opening up for a very specific small number of people. Maybe they'll do charter flights. I know there's some universities that were thinking of doing some charter flights out of parts of Asia to get some people out here. So anything's better than nothing.
What I heard through the grapevine in the last week was that at one point there was over 1 million Chinese students in Australia. Wow. I had no idea. Like 1 out of every 20 odd people was a Chinese student.
That's crazy.
Which is epic, but also highly disruptive for the education industry. When I look back at 2007 and 8, one of the things that got Australia out during the Rudd government in the GFC was massive amounts of immigration. So we went from about 300 to 350,000 people a year to 450 to 500,000 people in those 2 years. I honestly believe that the exact same thing's going to happen from about 2022 through to 2024. They're just going to let a huge number of people in. Again, I have nothing to support that. I just see it as one of the levers that they can pull.
Of course, and with our response to 2020, COVID-19, it's been pretty damn awesome in comparison to a lot of other countries. So it's going to look really desirable, and we're going to need to get the education sector booming again, which is going to be great.
One of Australia's largest exports is education. I had no idea.
Yeah.
Outside of tourism and agriculture. So and we go into that, domestic tourism, according to CBA, is set to boom. We're already noticing it on the sunny coast with the borders back open.
Big time. Like I was just talking to a client that's looking to come up over the Christmas and New Year's break, and he's actually had to push it back to late January. Fortunately, he runs his own business, so he's a bit more flexible with that. But he said he couldn't find one thing that was available between Christmas and New Year's.
To put it into perspective, I've got a little Airbnb on the sunny coast, just a tiny little 3-bedroom home that I run, and that is fully booked for months in advance now, which is incredible. To just also put it into perspective, like, yes, Sydney and Melbourne are oversupplied from an inner city unit perspective, but if you look at Perth, parts of Brisbane, Adelaide, Hobart, the vacancy rates and Darwin across those markets are all below 1%.
Yeah.
We've got some suburbs now which are sitting at literally a quarter to half of 1%, which is so undersupplied. And what that's meant for my personal properties is, in some instances, I've been able to increase the rent by $50 to $200 per week.
It's amazing.
At the moment, which is insane. And that's off the back of all of these people moving up from Melbourne, as well as the locals moving around for the first time in a year again.
Yeah, the SQM update in late 2020 that I saw, haven't seen the new one for the new year yet, but they basically said that vacancy rates remain steady throughout December in Australia, but Brisbane actually came back from 2% to 1.8% Brisbane-wide, which is just so low.
And this is something that I was talking about with Ryan on property in late 2020. It was around this concept that Australia isn't one market. Australia or Sydney or Perth isn't one market. Perth is a series of good opportunities and really bad ones.
Yeah.
And Sydney's the same. And so, you look at Sydney's vacancy rates at 3 or 4%. There are suburbs in Sydney that I'm aware of in the Sutherland Shire, for example, or the Northern Beaches where the vacancy, there's zero available properties for rent online. So again, just don't
generalize
think about that as you move into 2021. Invest with a specific strategy and purpose and plan.
Hell yeah.
You're a suburb buyer, you're not an Australian property buyer.
Yeah, exactly. And when you look at the data as well, it can be skewed plain and simply because of how large Sydney and Melbourne is. So, when those markets are struggling, when they've got high vacancy rates, or when they're declining in value, it makes the whole Australian market look bad. But you've got to understand that's because they control such a huge portion of the market. But that doesn't mean that that's the story all over the place. There is markets within markets. You need to understand that.
In 2019 and 2018, when property prices started to free fall in Sydney and Melbourne and decline by as much as 15 to 20% in most suburbs, or in some suburbs, it made the Australian performance look like it had declined by 10%. But if you look at places like Perth, Adelaide, Hobart, Brisbane, Canberra, very, very different stories. So again, it's nice for the media to pull highlighted pieces of information and not tell the entire story, which is why videos like this, as well as getting onto these reports and getting onto the people we're going to talk through today's information early, can give you such an advantage over the average person.
Hell yeah. And with CBA, they've actually updated their forecast. A lot of people have actually updated their forecast throughout 2020. But they've come out and said, we expect a much stronger recovery in 2021, and we have extended our forecast profile to end 2022. We now forecast GDP growth of 4.2% in 2021 versus 2.5% previously, and we expect economic growth of 3.8% in 2022.
That is super positive. Now, whether it happens or not, those expectations are really, really interesting. That means we're heading in the right direction. We're out of the first recession that we've been through in the last 28 years in Australia. And, that'll just build sentiment. It'll build confidence. Now, as an investor, you really, really, really want to be aware of what happens from 2023 through to 2025. That is when, the people that aren't listening to this sort of stuff will get their confidence back. And so it's really what you do over the next couple of years that will, really set you up for a strong second half of the cycle.
Hell yeah. It's just crazy to follow Phil and understand his updates and the way that the cycle works, and just puts you so far ahead of the curve if you just get in that little bit before all of the other people find their confidence and legs.
So Westpac recently came out in the Australian Financial Review, and they're expecting both Brisbane and Perth to increase in value by as much as 20% in the next couple of years, 2021, 2022. That's part of the sentiment story that's beginning to drive people back into these markets and making them feel super excited, or at least considering investing and buying again. Now, another thing that often happens in the second half of the cycle is we move into the era of easy and cheap credit. Now, they are freaking dangerous things, but amazing for people that own stocks and assets long term. So the Treasurer in Australia has just come out in late 2020 and said that he's beginning to relax some of the things they put in place after the GFC to protect Australians from the banking system. He's also reversing some of the harsher things that were put in place in the Royal Banking Commission. Now, about a month ago, just in December 2020, I heard an update that they're now relaxing APRA's credit limit for CBA, the biggest bank in Australia, from $1 billion in cash on hand at all times to $500 million, which effectively means if they're to leverage that $500 million, as banks do, it's going to create a unprecedented amount of ability to finance new loans for businesses, small businesses and properties.
That's massive. Now, it's been such a long time since we've had easy credit and we've had cheap credit for quite a bit of time now, but it's been a while, not since I've started even looking at the investment market, but you've had it previously when you sort of started investing.
The good old days. I remember in 2015 when APRA really came through and started to tighten things up, and it's been very hard from 15 through to 2021 to access finance. So back in 2011 when I was just getting started, and at the start of a real estate cycle, there's always easy credit. I was getting loans at 97.5 to 105% finance. Like, I'm not joking. They would pay stamp duty, lender's mortgage insurance, soliciting costs, accounting costs, and give you the deposit. You know what I mean? And that was just one of the ways, coming off a really severe recession or depression, that they kick the can back down the road and get things going again.
Kick the can back down the road. I absolutely love it. The government's good at that sometimes.
Always.
So coming into some info that we've heard from CoreLogic, is talking a little bit more about the housing finance and what's going on there. Now, if you've talked to a mortgage broker or you've got a friend that's working at the bank at the moment, I can tell you they are working hard at the moment. Every man and his dog seems to be refinancing their loans to get a cheaper rate or release equity to do renovations or buy more properties or upgrade. It is cranking at the moment. But what we're seeing is a continued rise of owner-occupiers and first home buyers in the market, which is being led by Queensland at the moment.
Simon and I got a really good update from CoreLogic, and if you haven't subscribed to their weekly, monthly newsletters, I highly recommend it. But what they did, I think it was CoreLogic or SQM, they looked at data from 2003 till 2020, and they basically looked at capital growth. And, capital growth, like housing is very boom and busty, or it's very bubbly. Like if you look at the long-term trend, Sydney's done 190% growth plus in the last 20 years. Melbourne's done 210 plus. Brisbane's done 170% growth. But if you look at the actual year on years, it's like up and down and up and down.
Yeah.
And so what they did is they overlaid the number of new mortgages being written back to 2003 against capital growth, and it is the most accurate lead indicator that I've ever seen.
Yeah.
Whereas the number of new mortgages spike, capital growth follows that. And then as the number of new mortgages being written, like in 2018, they massively declined on the back of the APRA changes to slow things down. That's when Sydney and Melbourne went into free fall. So really interesting indicator. What's most important about that is number of new mortgages are up 30% in Brizzy and 35% up in Perth. So, if that's not something you should look into it.
Hell yeah. Coming back to some CommBank stuff as well, talking about COVID, the threat has really diminished in Australia, and we can see that, the contact tracing has been second to none. It's been absolutely amazing watching these little clusters pop up in certain places and just seeing how quickly the government's response has been to that, which obviously is coming back to the consumer confidence and sentiment as well. Without having this big looming threat of COVID, people are going to feel a hell of a lot better about their situation.
2020 was a tough year, like not just statistically, but also like mentally
Emotionally.
for so many people. Emotionally, like Simon and I are like super positive people, and it was interesting to like hear where people are at. And what I realized is that 90% of people were really good. 10% of people controlled the complete media conversation for the year and therefore controlled the general sentiment. But, I'm excited for 2021 to sort of get back to normal, because like we're just buyer's agents. We're not counselors. Like we can't give financial advice or anything like that. So it's like, it's really nice to be moving into a positive sentiment place where people are just semi-excited for what could come over the next 5 years again.
Yeah, and not attaching onto a lot of the things that they hear. But I felt it throughout 2020 as well. Like, it was just a friggin' weird year. There was times where I definitely, lost the plot of more often than I would have if I was just, in a normal year, because you just become a bit of a product of your environment, right? And sometimes when all of this fear is circulating, you just kind of jump onto it. That little lizard brain loves to jump onto those fear stories.
In 2020, I think we spoke to over 600 new people and about 400 existing clients throughout the year. And just listening to where people were at mentally, and myself included, having so many conversations, it was nice to gauge where things are at. And even the conversations we've been lucky enough to have already in the new year through the free strategy sessions we offer have been so positive, and it's just a very, very different convo, which I think we're a very early indicator of what's to come that way. So what else is CoreLogic been saying?
CoreLogic, this is more of a 2020 thing as well, so sorry for that, but I just think it's really important to kind of break down the actual performance throughout 2020. Well, this was up until November of 2020, November 30th of 2020. So The annual return in Sydney actually ended up being 3.7%.
Positive. So it actually didn't decline in value through this recession.
Exactly. Melbourne was the only capital city throughout Australia that recorded a decline, but the decline was only 0.9%, so just under 1% of a decline there. Brisbane's increased by 3.2%, really positive. Adelaide 5.3. Adelaide's been cranking recently. Perth an increase by 0.8. Hobart an increase of 5.6. Insanity.
Hobart's been on the best 6-year run of all time.
Yeah, legitimately. Darwin 5.9. Canberra 7%. So the combined capitals an increase of 2.4. But what was really interesting, the combined regional markets increased by 5.7%, which makes a lot of sense with everything you've been hearing about people leaving the big cities and going into these markets. I know crazy things have been happening in parts of the Central Coast, crazy things in Byron Bay. Sunshine Coast is insanity at the moment. I bought my house in June of 2020 for $560,000, an unrenovated house on a big block. Now,
that was a good price, bro.
Such a good buy. Now, a comparable property, unrenovated, but that was only a 3-bed, 2-bathroom on a smaller piece of land, was listed in December for $650,000.
Yeah, unbelievable. Like when you think about the land component that you've got, the better location, as well as the renovation that you're doing in the new year, like it's incredible. Like, and what I love, man, is it wasn't easy, even though we're in the space. Like you and I both bought properties between March and December 2020. It's not comfortable, even with the amount of information we get, that, and we don't share a lot of really good information that we get from people either, to just like stomach buying when everybody else is telling you to do the opposite.
It's so hard, but you just got to reiterate everything that you've heard from the most successful guys of all time. We've talked about him. We talk about him in every single podcast. Warren Buffett, Ray Dalio, Phil Anderson, all of these big dogs. It's be greedy when others are fearful and be fearful when others are greedy.
It was the first time I actually have felt it, because back in the GFC, I was at uni. And then I finished uni in 2009.
Early 20s, you're just full of beans. You don't give a shit about what's going on externally.
I didn't even know we went through a GFC.
Yeah.
Because I was on Centrelink and working in restaurants on the sunny coast, and restaurants were booming.
Yep.
So it was like, I started to buy, and people were like, why are you buying? And I'm like, why wouldn't I buy? Like, everything's cheap right now in Sydney. And it's like, I had no idea that, people had just gone through 3 to 4 years of the hardest times of their lives. And I'm sort of grateful that I didn't know, because maybe I would have sat on the fence for an extra couple of years. I don't know, but what I'm really proud of myself is, because you don't know who you are until you're forced to confront it. And I'm really grateful that at a time of mass hysteria, we were able to like stand in stillness, not run away, not fight, and just make really strategic decisions. And they've ended up being incredible decisions. Yeah,
great decisions. Like we were talking personally, we don't normally talk about that on camera, but we were talking in the middle of the GFC, and we're like,
GFC?
GFC in the middle of 2020. Let's just call it 2020. We were sort of seeing things increase in July and August, and it was just a steady increase from July basically. And we were saying that the buying opportunity was sort of between March and June, but it was so scary at the time. But now, super grateful for those decisions and being able to overcome those challenges.
I remember sitting down with my father-in-law and saying to him in March and April, because I'd been very aware from Phil Anderson's work that the mid-cycle was coming down. You can look at the videos that I did in 17, 18, 19, really educating people on what I'd learned from him and saying prepare. And so I'd sold properties, I'd gone interest only on all of my home loans, I'd set up offset accounts, I'd saved a lot of money to prepare for like a really rainy day. I'd talked to mum and helped her get her money out of her super into cash, and then back into the market when it was like the right time. And I was scared as hell, but I was also very, very aware and in the best possible position. What I didn't know is like the effect it would have on our business in terms of would we even be able to make money, because I didn't know if anyone would want to work with us during that time. But 165 people in 2020 decided to sign up with us, and it's an incredible thing. Like 130 of them were strong enough to buy at that time, and have, you know, I'm calling people 3 months after they've bought in some cases saying, hey mate, your property's gone up by 50k.
Yeah.
Just because we were the only person, buyer's agency or investor, literally buying in Brisbane between March and June. Like there was not even a single competitor. It was fucking crazy.
Yeah, it's still super hot as well. You know, we're feeling it right now.
Yeah, well, sentiment's back and stuff like that. But you know, to talk positive, and again, I'm like, this is one of the most interesting indicators I've ever heard, like the number of new mortgages. You know, we're constantly learning. I didn't know about new mortgages to capital growth, and I had no idea about this until you showed me. But for every 1%, or they call it 100 basis points, that the Reserve Bank of Australia drops the interest rate, they expect it to lead to an 8% increase in property values over the following 2 years.
Man, I'm so glad that we follow these guys, because, you know, sometimes you'll read an article and you just don't get anything out of it, but at least once a month there's just some little gold nugget that is just like, boom, mind blown.
Now, if I'm in Perth or Brisbane and I'm an investor looking at those markets, knowing that CoreLogic said that they're cheaper to buy than they were 10 to 14 years ago, depending on the suburb, and the cash rate or the interest rate has gone from 7% in 2011 to 2% now, that's a 5% decrease, or a 500 basis point decrease in the interest rates, and we haven't seen any growth yet. So for me, I'm looking down the line and going, that's like really, really exciting about what could potentially come.
And what they continue to talk about is, they were saying that it's not uncommon for housing markets to increase in value during negative economic shocks or during periods of rising unemployment. And they say this is because the monetary response to rising unemployment and falling consumption is often to lower the price of debt.
You know, so we've talked about these levers in previous videos. Ray Dalio talks about it best, but one is making debt cheaper, which is reducing interest rates, which you've seen all over the world in 2020.
Yep.
You know, some people, if you look at the long-term interest rates that you can fix in Australia, some of them are at like 1.9 to 2%, which, you know, there's people saying that Australia might still go into negative interest rates, which would be insane. You also look at the dropping of helicopter money, like we've seen through JobKeeper, JobSeeker, and all of that money that they distributed to the Australians earning, you know, in the lower quartile of the earning spectrum in Australia. You know, there's just so many things that these governments have learnt since the Great Depression, which they can turn on and off. Another one is printing of money. Another one is taxing companies and wealthy people. And Australia's done almost all of those except tax the wealthy at this stage of the cycle. And
that'll probably come.
It probably will come at some point. And so it's just important to note that, like, there's things that they consistently do. And again, like, they do more of these things in the middle of a cycle than they have levers to pull at the end of a cycle.
Exactly. One of the questions that comes up, or we were actually talking about this off camera, what we've been hearing from local real estate agents, it's the fear of the mortgage deferral payments coming off in March, essentially, this year.
And that is a honest fear that is backed in some logic. Like, I don't want to discredit that just before we start talking about it, because many small businesses and people will be exposed at that time, and there will be people that will be forced to foreclose on properties.
It'll be interesting to see what happens. And, you know, basically what they've come out and said is that mortgage repayment deferrals have acted as a temporary stopper in this vicious cycle. Those that did not want to sell amid economic uncertainty due to an inability to repay their mortgage did not have to. That is just such a nice thing to know that you can do.
That was a beautiful thing the Australian government did, and the banks had the Australian government's back because they're incentivized to financially to just push people's loans on holidays for 12 months.
Yeah, exactly. And the banks actually end up making more money from doing that as well. Now, they said that this may have contributed to very low levels of stock throughout 2020, and we've felt that as well. We've felt like lower levels of stock on the market for a very long time. It's actually about 25% lower than the 5-year average at the moment.
Yeah, you know, and that means that there wasn't this massive amount of supply that people were worrying about with no demand in the market.
Exactly, but then this low level of stock on the market likely helped to insulate dwelling values throughout this time.
Now, I believe that the Australian government is going to continue to step in with some sort of job seeker, job keeper payment, and also supporting the banks. I've got nothing to base that on, but I just feel like at this particular time, we'll continue to do what we can to get the show back on the road.
Yeah, just Band-Aid after Band-Aid, and then they'll probably run out of Band-Aids at the top of the cycle.
Yeah. So one of the interesting things from the Financial Stability Review was that half of owner-occupiers have at least 3 months or prepaid at least 3 months in advance on their mortgage. So a lot of Australians are in a good position. You've got to remember that 30% of homes in Australia are owned by investors, which are receiving rent, which makes those homes much easier to hold. Another almost 30% of Australians own their own home completely debt-free. And, the 40-odd% plus of Australians that, like myself, still have debt on their own home or investment properties as well, generally have, a bunch of them have buffers in place. A bunch of them have actually prepaid more than they need to. And then with the fact that the banks are prepared to give us these holidays if required, it's just helped insulate us against some of the harsher parts of other economies haven't done this, and you can see that for some of them, it's been a bit of a bloodbath.
Makes me feel super grateful and fortunate to live in a country where we do have these types of measures that can be put in place.
Now, they've said continued leniency for mortgage repayment deferrals, particularly for owner-occupiers or mums and dads, is in the interest in the banking sector and extends the bridge to recovery as the economy recovers. Now, that's important, and that's why I'm confident they'll continue to step in.
So for everybody that's really excited about cycles and data, what we're going to move into now is just some information that we've been provided from Phil Anderson and his team, and also Fred Harrison.
This is the stuff that has made me sleep so much better in the last 4 years since I started to become aware of it. I was reading yesterday in one of Catherine Cashmore's updates, I think it was, that there was a guy in France in 1892 who studied real estate prices in Paris between the 1200s and the 1800s, and he published his works as a scholar and identified the exact same cycle in place that Fred Harrison went and found after looking at the UK for 400 years, and Phil Anderson went and found after looking at the American market for 250 years. It's just a human experience to be overly fearful and overly confident at different times throughout a long-term cycle.
It's important to understand that, potentially for the last 800 plus years, we've been running in these cycles, and the big dogs understand these types of cycles as well, and there's so many really interesting, cool, different ones. But what we've really fed into is this 18.6 year cycle from Phil. And the cool thing is about this is as time goes on, they just continue finding more information, finding more data, incorporating that into current cycles, and also doing additional research on previous cycles. So it just seems like they get more and more confident with every single one of these updates that we get.
So Phil's latest update, which is always amazing, I highly recommend anyone who isn't subscribed to his stuff to subscribe to it. There's a small annual fee, but every single week when I get his updates, I smile. It's just so reassuring to have someone thinking 6 months in advance for me at all times. So here's the cycle, right? Phil Anderson tells me what's happening 6 months before, as does Ray Dalio, as does Fred Harrison. Then CBA and Westpac come out 3 months after that and say the same thing. And then 6 to 9 months after that, the media starts coming out with the same stuff. So I'm such a cynic and a critical person, and I have no faith in the dates of the cycles at all. But what I have faith in is human nature and a series of processes that have worked for governments around the world and reserves and federal banks to pull people into and out of these things based on it's really greed and a false economy. But what Fred Harrison went on to say is always the boom would reach a point at which speculators could not earn enough in rent to pay the interest on their loans. Phil Anderson then goes on to say, and he said this back in 2017, 18 and 19 as well, we didn't reach that point in 2020, In fact, we're still a long way from the rent not covering the interest expense. Actually, we're nowhere near it. Now, that's really, really, really important, because what happens, particularly in the second half of the cycle, is people start making easier money, quicker money, and the banks relax and the governments relax to get out of this position we're in. A lot of money goes out, and anyone that's seen The Big Short in America and that scene where they're talking to the mortgage brokers who are writing loans to strippers.
And this we just got going.
Yeah, they just get looser and looser and looser. Now in America, Trump unrolled all of the stuff that Obama put in back in 2018 to protect the American people from the American banks. The Treasurer in Australia is honestly doing everything he can at the moment to try and do the same thing. And what that means is that people get loans easier, cheaper, without as many checks. More and more dodgy people come into the real estate industry, like brokers, people looking to make quick money, because when this thing starts going, it's kind of like crazy and Bitcoin-ish. And, what happens at the end is, to slow things down, like we saw in 2018 in Sydney, they either do one of two things. They just stop the availability of credit and pull the rug from under people, which means people can't refinance as well if they're in hardship, or they progressively step interest rates up to a point where people can no longer afford to pay the interest, and they start first flogging off their own investments, and then secondly, their own homes when they get in shit. Now, I was talking to Minka, one of the top agents on the Sunny Coast, literally yesterday or the day before, and she said she got herself into a bad position in the GFC. She sold a home which was valued in 2007 at 1.6 mil for 900K on Oceanic Drive, which is on the beach. It just got resold for 2.8 mil.
Wow.
In 2020. So
wow.
It's everywhere. Like, it's just, if you look at the data enough, you can see it everywhere.
And it's starting to happen. In another one of the updates that we received, it was in middle of December, they were saying that there's this club, this very exclusive club that's opening up in the United States.
Yeah, that's right.
Which is the $100 billion club, which is
the $1 billion club.
That's the $1 billion club, which is essentially these brokers that write up over $1 billion worth of loans in 1 month alone. Now, there was only one guy with the
1 year.
1 month. Yeah. Ben.
Sorry, I was almost going to cut that out because I was correcting Simon. 1 month? Are you
1 month.
What?
1 month. So there's only two guys in this club, but super exclusive, and obviously, they're promoting to write up more and more loans, and this is where the greed takes over, and people stop thinking about what they're doing, and they're just thinking about themselves.
I know my broker writes about 10, maybe $20 million worth of stuff a year, and he is working 24/7. Like in 2016, he was emailing me on Christmas Day.
Yeah. Like I still stay in contact with a few brokers, and every single one of them's like, I'm like, you're getting a bit of a break this year, and they're like, no chance.
No break. All of the building companies we know, except one, are working through the break. All of the agents, or actually most of the agents, will take a holiday because the listings just stop for about 2 to 3 weeks, but then it'll be ready to rock and roll again.
Now, this was a really interesting update that we got from Akil Patel, who's essentially Phil's right-hand man. And this was actually written back in 2017 for his subscribers back then. But it's just given some really cool insights about what happens throughout the cycle and how you can use that to your advantage. Now, the first one is land is the real asset, not the building. And we talk about this all the time, and Fred Harrison wrote the book about it. The power is in the land. And it's just really important to understand that this year, coming into 2021, where a lot of you are probably thinking of getting another property under your belt or into your portfolio. Make sure that you're focusing on the right things and you're not going out there and buying the off-the-plan units. Make sure that, when you are focusing, you're trying to get the largest possible land component that you can.
I love that. Like, it's a simple thing. If you look at the way the Australian government depreciates a house, it's 40 to 42 years and the value is written down to zero. So it's really important to know that high quality locations are always going to, and larger piece of land, outperform lower quality locations with a smaller land component.
Exactly. The second insight was borrowing to acquire a property in a good location and having somebody else pay the interest. This is property investing 101. How bloody beautiful is the fact that we can invest in assets that are going to appreciate in capital, but while you hold it, you have people paying off your interest portion of that loan.
I love what he goes on to say, like the simplest way to profit from this is to buy a good location and have someone else pay off the interest on the borrowing to acquire it. The earlier you buy in the cycle, the better, but don't be afraid to buy even after the cycle has started.
That's an important one to note as well, because at the moment, with a lot of people feeling the pressure, especially if anybody's trying to look for themselves and they're contacting local real estate agents, you would know that there's heat on the market. And I have chats all the time and people go, have I missed it? Have I missed the opportunity in Brisbane or on the Sunshine Coast? And no, essentially you haven't missed the opportunity if you are getting in early enough.
Yeah, you know, if you look back, yes, it's warm, but that warmth hasn't translated into meaningful price gains outside of the suburbs within 10 k's of Brisbane CBD at this stage. The third insight's take advantage of the law of absorption. Now,
love this one.
Anyone that's grown up in Sydney or Melbourne has seen this on point. So 20 years ago, 25 years ago, Pyrmont in Sydney was an absolute shithole. Now it's one of the most exclusive and sought after areas in Sydney. Then Surrey Hills went, then Newtown went, then even Redfern went. Maroubra Beach went, Bondi Beach went, Cronulla Beach went, even Brighton Sands has gone now in Sydney. If you look at the northern beaches of Sydney, Dee Why was like considered a cheaper pocket and a more affordable one. It's gone now as well. Now, same thing in Melbourne. You look at places like St Kilda, Port of Melbourne, a lot of the suburbs in the Mornington Peninsula or Geelong. Again, this concept is the growth starts from the middle or the city or the best beachside locations and then slowly triples out.
I absolutely love this one, especially with the opportunity up here in Brisbane at the moment. If you're able to identify those areas that still have that stigma about them, that people still don't like, you know, maybe there's still some housing commission, or maybe there's still a lot of renters, or the wages hasn't necessarily increased, but you look at the neighbouring suburb or a suburb that's within 1-2 kilometres and the median house price is $100,000 to $200,000 higher, the average household income is higher, the amount of owner occupiers compared to renters is higher. And I love trying to find those little hidden gems about those areas that are expected to gentrify, that do have those economic fundamentals that we look for, and you can still get in there before they have started to turn at the most amazing prices. And this, I've personally used this for my 2 investment properties in Brisbane, and I'm going to do it for my 3rd investment property down there this year.
You know, recently Simon and I went through the data like we do to check out what's going on, and there's 2 things that I've noticed in parts of Brizzy right now, right? So there's a suburb 9 kilometres to the CBD called Wavell Heights, for example. It's a absolutely beautiful, sought after suburb. It's got a brand name like BMW or Mercedes from the locals. Like, they just love living there.
Yeah.
Now, 5 years ago, I could buy properties there for clients for $450K. Now a knockdown in the suburbs worth $800K. And a beautiful, beautiful Hampton-style home in the right street is selling for as much as 1.7 mil. Now, in some of those streets where there's these houses selling for 1.7 mil, you might be able to still buy for 900 grand, which is from a suburb perspective, like if you look at the law of absorption, it can even work in a suburb when you see a highly, highly valued, beautiful new product and then a really undervalued product, because it's sure as hell doesn't cost 800 or 900K to build that product. That represents a big opportunity, and that's an early indicator for me. I've watched it in Sydney and Melbourne of things that come in particular areas. Then if you go, that's 9 k's from the city. There's some suburbs in Brisbane that are 7, 8, 9, 10 k's from the CBD. For some reason, are still only worth 550K to 700 grand. And you've got the suburb right next to it where properties might be selling for $400,000 more. So this law of absorption hasn't gone all the way through Brisbane or Perth like it might have gone through Sydney and Melbourne in the last 7 or 8 years.
Exactly, and we'll talk a little bit more about that in one of the other insights. But Insight 4 was talking about buying close, but not too close, to new or improved rail stations or transport links. This isn't new information. You know, everybody knows that, you know, the closer that you can be to quality public transport options, or if there's a new train station opening up, or they're upgrading a new an existing train station, it's going to be good for the suburb.
You know, whether it's a uni, whether it's a main road, whether it's a hospital, whether it's a train station, they say Insight 5 is when to buy. The 2 years before the construction's completed, and generally the 2 years after. But from my own experience, I actually really think it's the 2 years before it opens up. Having looked at property prices in Batinia around the hospital, having looked at property prices in like the Redcliffe Peninsula in Brisbane, where a train line opened up back in 2016, there were really, really strong gains in the year leading up to that, and then strong gains in the year after, because investors flocked to that new piece of infrastructure.
Now, where can you find this information?
Actually, this is the beautiful thing about Australia. If you just type infrastructure projects plus Australia plus government, it'll take you to multiple pages, and then you can filter it by state. The beautiful thing is the Australian government is so proud of getting itself into debt that they tell you where they're going to get you into debt years before they get you into debt. So
I love that.
So it's like, yes, $500 million project. And you drive past it fucking everywhere. It's like, they're like proud to just get us into $500 million or $1 billion worth of debt. It's like the more debt, the more proud they are to like tell everyone about it.
I love it. Okay, cool. Insight number 6, the cycle starts at the center and ripples out. So this is what we were sort of talking at a little bit more in insight number 4. But essentially this ripple effect is, and we're seeing it happen on the Sunshine Coast in particular, but parts of Brisbane as well. Generally what you see is those quality areas start to move first, and then it will ripple out from there. Like when you drop a rock into a bucket of water, obviously the center, and then it comes out further from that. We've seen it happen in Sydney from 2012 through to 2017. We saw it happen in Melbourne from 2013 through to 2017-18. And we're starting to see it locally up here on the Sunshine Coast. Those premium sector markets are starting to move. And then that's sort of trickling out into some of the other locations also.
This is super important because it works on a macro and a micro level. So if we go up a level, if you look at what's happened in the first half of a cycle, the rock has dropped and it's rippled into New York, London, Singapore, Hong Kong, Sydney, Melbourne, and every other major capital city in every other major country around the world. And those markets have gone boom. Now, what happens in the second half of the cycle globally is those second and third tier cities, like the Perths, like the Adelaides, like the Brisbanes, like the Canberras, do much better. Now, that's at the bigger level. Then if we reduce it down to like a suburb level, the best houses in the best streets in the premium parts of the suburb go first. Then once they're unaffordable, people go for the second and the third best opportunities. And that is, if we go up one more level again, the same for a city. So let's say Brisbane, the best locations on the beaches in the CBD have already gone up 60 to 100% in the last 10 years. Then there's these suburbs next to them that have done absolute donuts and nothing over the same period of time. So it's important to remember that when we talk about, or they talk about things rippling out, there's a global context, a local context, a city context, and a suburb context. And you as an investor can take advantage of all of them if, like Simon and myself, you're thinking about that stuff.
And we are, no doubt about it.
Constantly.
Like, constantly. And you know, sometimes you even need to maybe shift your strategy, like I have had to this year because of exactly that.
Yeah. So, you know, like another example of this is there's beachside locations, you know, very, very close to the CBD of Perth that might be worth $1 million. Then there's something 15 to 20 Ks up the road that might be worth 500 to 600. That is the type of ripple effect that people should be aware of as they continue to move into the markets.
So that's what we were talking a little bit about in Insight 7 as well, which essentially what Akil said is growth in peripheral locations can outstrip central ones in the central half of the cycle. So that's exactly what we were just talking about. The big dogs, the Sydneys, the Melbournes, do very well in the first half of the cycle. And then those secondary cities like Brisbane, like Perth, like Adelaide, tend to do really well in that second half of the cycle, and this is shaping up to happen once again. And if you looked at the previous 18-year cycle, it happened. If you look at this cycle that we're currently in right now, it's unfolding before our eyes.
You know, I've looked at the last 60 years worth of data, and then I've overlaid Fred Harrison and Phil Anderson's work, and some of these top dog cities actually do insanely well in the second half as well. It really depends on like one or two things in Australia, which is how much international money they're going to allow into those cities, and how much institutional money, being the big companies that want to buy them up, they're going to allow into those markets in the second half. Now, if they do that, there's every chance that those markets could be worth a lot more in the future than they are today. If they don't, then these second tier cities have a good opportunity. What I observed personally was that particularly Brisbane and Perth, in this coming 5 to 7 year period we're going into, historically have done extremely well. And that's because, not because of anything special. Like, yes, there are a lot of people moving here. Yes, incomes have increased. Yes, it's a lifestyle thing. Infrastructure's going in.
It doesn't make a lot of sense.
But it's more the fact that Sydney and Melbourne are just so bloody expensive right now that people are choosing to flee. Even before the virus, more people are moving to southeast Queensland than anywhere else in Australia in terms of Aussies. And, you know, because of that like shift from an expensive market to a more affordable one for lifestyle, which happens in the second half, that's why these peripheral or secondary markets can do very well.
Yeah, well, just think about it. A lot of these homeowners in Sydney or Melbourne experience really strong capital gains throughout the first half of the cycle. Now they're getting to a point where, like, look, we could sell up here and have a whole bunch of equity. Then we could upgrade our home and lifestyle by moving to a place like southeast Queensland or Perth, wherever it may be.
Yeah, without a doubt. And, you know, I talk to people every single day of the week that are moving up, and not just, you know, income earners in the 60K bracket, like 2, 3, 4, 500 grand a year income earners that have worked out throughout the virus how to work remotely and just check in with their teams, you know, a couple of days a week if they have to jump on a flight.
Exactly. Now, one thing coming into 2021 that makes me feel a lot safer through this acquisition phase of my portfolio is the fact that we've got these record low interest rates that we've been talking about, but the RBA is expecting to hold that cash rate for the next 3 years, which just is going to enable a lot of people to get that confidence to get into the market, knowing that we're going to have these really low interest rates. Now, of course, they're going to rise over time. There's no doubt about it. They just cannot hold them where they are right now, but it definitely gives you that little bit of confidence and also that little bit of extra cash to work with while you're getting into the market. It's helped the hell out of me while setting up my portfolio, and without those rates being at such low levels, there's no chance I would have been able to buy 3 properties in the last 2 years, let alone 4 in the next 6. Have my 4th within the next 6 months.
Without a doubt, man. Like, that's something that Simon and I think about and talk about to ourselves. Like, and go talk to your mortgage broker, financial advisor, or accountant about this. But I've talked to people recently that have 4.5% interest rates, and literally either call the bank and reduce it to like 3.5%, or go get a great mortgage broker and get it to like 3%. That difference might not sound like a lot, but on $1 million, we're talking about thousands of dollars a year. On 500K, we're even talking about thousands of dollars a year that people can save right now. Some of the things that I've been doing to improve my financial position and protect myself and reduce my risk on my properties throughout this process has been, you know, really focusing. I refinanced every single property this year. Got some really good wholesale lending rates when other people weren't looking. Also, like, setting up offset accounts, so any extra cash that I have can be stored in there and therefore help to reduce my rates. I've gone interest only, which again, you've got to talk to your advisors about this, but for me personally, it was just a way to control my cash flow without the pressure of having to pay 50 grand or 70 grand a year in principal across my properties. The other thing that I've done is I've really looked at the market from a rent perspective, and in many cases outside of Sydney and Melbourne, rents have actually are going up right now. People, because finance has been so hard to access since 2016, it just hasn't been mums and dads or home buyers that have been out of the market. All of the developers have not been able to access finance, whether they're small or large developers. And so there's this chronic undersupply of available property that's ready to build on today that the market wants in a lot of parts of Australia. Yes, there's an oversupply of shitty units, but I think Australians are slowly starting to learn that lesson. But, it's just an interesting thing to note.
Yeah, I'm currently going through this with my mortgage broker at the moment, because throughout that acquisition phase over the last couple of years, I've been get into the market as a priority. Just get into the market, get the properties under my control. So I had to kind of work with whatever banks would want to work with me. But now that I've got those properties and I've been able to get myself into a better financial situation, I'm going to refinance all of them, get a lower interest rate than I was initially paying, go to interest only on my investments just to increase that monthly cash flow for myself, and also go onto a principal and interest loan of 2.09% for my principal place of residence, which is just
phenomenal.
I'm so grateful that I have this opportunity at the very beginning of my journey. But everybody that's listening right now has this opportunity to literally just call your bank or call a mortgage broker and go, hey, I haven't really looked at this for a number of years now. Could we please try and work something out?
And don't be afraid to put some pressure on them. And all of these guys know that they can reduce their rates for you rather than lose you. Or if you have to move on, move on. The last one I wanted to talk about, just to wrap this up, is something I read from CBA. Now, apparently Australians have saved a ridiculous amount of money in 2020.
I did.
Yeah, I definitely have saved cash too, because I'm not holidaying, I'm not eating out for a long period of the year.
Normally we'd go on at least one overseas holiday per year, and at least out to breakfast, lunch or dinner, once or twice a week.
Yeah.
But that was sort of taken away for about 6 months of the year. Traveling overseas, who knows when that's going to come back.
I'd normally spend at least a couple of $1,000 a year on clothes, and I just didn't want to go anywhere near the shops until recently. I still don't really want to go near them, because I'm just aware of how grubby they are. They're like little petri dishes, but it's I have been it's just it's just I'm just when everyone's got a vaccine, then I'll be free for all. But
Ben's like the guy from The Aviator that's just a germaphobe. He's going to lock himself in his room and just never come out.
Start pissing in cans and stuff. But in all jokes aside, people have saved a lot of money. Apparently CBA said that just household savings are over $100 billion and about 15% up on their long-term average. Now, why that's important for us in 2021 is the fact that because it's sitting so far above the normal levels, once sentiment comes back, once people are working again, once the Australian economy is doing its thing again, a lot of that money is going to come rushing in. Now, it's going to come into properties, rents. It's going to go into the stock market first and foremost, because they're the things that always capture anything that's left over from society. But a lot of that's going to go into cars, food, internal travel. I didn't realize, but apparently Australians spend about $36 billion per year in international travel. Now, we also have about $40 billion a year of people coming to Australia, which they can't come right now. But that money is going to result in, like we talked about before, an incredible domestic tourism boom. And so, just know that for a lot of people, it's actually been an incredibly positive year financially, even though it's been an incredibly stressful year in 2020, negatively, emotionally, mentally, work-wise. Everyone knows someone that's been impacted really poorly, but 2020's looking up.
2021
is looking up. We have no idea what's going to happen this year.
I think there's still a bit to get through. There's still
heaps to get through.
There's still a lot to get through in 2021, but the overall outlook from us is once again optimistic.
Yeah, and again, that's based on these guys' reports. I've got no perspective on this shit because I don't know. As always, we're taking a long-term 20 to 30-year view as investors, and we expect over that period of time for incomes to grow, for rents to increase, for our property values in the stock markets to grow, but we never know, which is why we also have a secondary plan, which is get properties with great potential for growth, but also extremely strong cash flow, so that we can pay them off outright, we can get that passive income stream for life. And, for me personally, this has been a huge wake-up year. I want better choices next time this comes around. I didn't want to freak out about, is someone going to want to work with me this year or not, next time we get into a tricky position like this. And so, I've sort of doubled down on the investing, paying off the debt, buying a couple of assets that will really set me up in 15 years. And I hope you've used 2020 and you use 2021 to your advantage, in the sense that, you get that plan in place with the right advisors, you slowly, create a strategy that works for you, and then you slowly and confidently do work yourself into the market to get yourself and your family, or yourself and your partner, into a great position long term.
Thanks so much for sticking through this one, guys. There's been some absolute gold in there. I hope you have the most amazing year to date, and go out there, invest confidently, and hopefully get some good results.
Oh, sweaty, so sweaty.